So all this while we've been knowing substantive procedure. So what exactly is substantive procedure? Okay, if you look at SP, you just need to think of this in this way. Think like this. Okay? It's all about what you as auditor will do to confirm a figure in the financial statement that you see is not materially misstated. What you as auditor will do to confirm a figure that you see in the financial statement is not materially misstated, or alternatively is correct. Okay? So that is what we're going to see now. That's your procedure. That's your action. That's your work, your audit work. Okay? That's your audit procedure. That's your audit work. Okay? It's your action, what you're going to do. Now, so to understand what you're going to do, I think you must first understand the mechanism between accounting and financial reporting. The figures that we want to check and confirm that is not wrong would be figures in the financial statement. Okay? Now I just want you to think like that here, okay? So that you get an understanding. So the figures that you're supposed to check will be figures coming from financial statement. But financial statement figures come from where? Come from where? Financial statement figures come from where? Huh? Wow, you all don't know financial, huh? Accounts, yes. Account is the last point already. Last point. Of course, in between, there's a lot of posting here and there. For example, the figures you see on the face of your financial statement, they all are summary, correct? Huh? And this summary actually carry a lot of figures that they move. That's why we prepare notes. Agree? The notes show a lot of figures, and the figures are all taken from trial balance. And I've got a trial balance come from accounts. Does it not? But of course you say come from accounts. So if you just want to put 2 points, then you're just going to tell me that the figures in financial statement are all taken from the accounts. So even if my accounts are correct, but I don't post them correctly, financial statement can still be wrong, right? Agree? Huh? Because maybe in the accounts, I can tell you my property, plant, equipment, the cost is 1 million. But when I pick up the figure and show in the balance sheet here, I show as 1.2 million. Still wrong, correct? Huh? Because you're not showing exactly the same figure in the accounts. So that's why, to make sure that the figures that you see here is not wrong, is correct, the first thing we need is to make sure that what you see here and what you see here must be same. The figure here and the figure here got to be same. And how do you make sure that the figure here and figure here is the same? Just look at the numbers, correct? Huh? Look at the account, 1 million. Look at financial statement, 1 million. Okay, they're the same. That's what you do, okay? So we call this process as our standard procedure. Okay, we call them as a standard procedure. Now the reason why we call them as standard procedures are because we got to do it again and again, keep on repeating, but for different things. Agree? Now I'm going to do this for my property, plant, equipment. I'm going to do it for my receivable. I'm going to do it for my bank and cash. I'm going to do it for my creditors. I'm going to do it for everything. So everything you see in the figures in the financial statement, they all come from the account. So it's just going to keep on repeating the same thing. That's why the process is so repetitive, so redundant that we just call them the standard thing that we do. Okay? So it's called the standard procedure. So the purpose of standard procedure is just to make sure that we agree so that the figure become completely correctly posted from account to financial statement. Okay, so take example. We have your PPE. Now, I just show you. You don't need to turn. You just see it. Okay. Anyway, I don't think there's a need to change, so I didn't change this. That's why it's still the 2007 financial statement called balance sheet. Now it's called statement of financial position. Then they are very free, nothing to do. They change the income statement also. Correct? Now it's called statement of profit or loss. See, they are like that, okay? Because they feel inconsistent. Everything got statement, then income statement, the statement at the back. So accountant all like that one, you know? So that's why they want to change. Funny thing, okay? Now, so anyway, I believe there's no issue to us. Whatever you call the audit word is the same. Now, so now in the so-called balance sheet here, there's so many things that we see. And these are all only the asset part, okay? Not even other things. Now, let's say I'm just interested with one part over here called property equipment. And the figure that we see is this, the 864809. Now, of course, the figure is group, but it's okay, although you don't do group audit, okay? Now, so one thing that you check now is this figure. Your mission is, what will you do to confirm that this figure is correct? That is 864809. That is not 82480. So how do you do that? So first of all, I must ask myself, this figure come from where? Correct? So the figure come from where? So I believe this is a carrying amount, a net figure. That if I look at this, I know it must come from note 18. So if note 18, then I must go and see note 18. Okay? And true enough, in note 18, we see loads of figures. That all the movements that we see here, if you net them, that's how I get 864809. Now, you just imagine this piece of thing is prepared by an outsider and pass it on to you. So the first thing I ask you, take from this attitude. This piece of paper show how much money that belong to you, I must give back to you. So I just show you a piece of paper. I say, now this is all the money that you have. So all this money add minus, the total is 864 million. So I must give you 864 million. Will you immediately believe the figure? No, because it's your money, right? You are my 864 million. Well, you simply add 1 million lesser, then my money become lesser, right? So see, your money, your attitude become like that. So you must always carry this mindset. You're auditor, you're checking figures for people. So you say, okay, wait. You take a calculator. Wait, you add first. Add minus. Oh, okay, get this figure. Then add minus, you get this figure. Now that's what you're going to do. You're just going to add minus and see that arithmetically whether the numbers add up to this number or not. That's the very basic thing you do first. Now, that is the first thing I do. I'm going to make sure that the numbers that we see here is actually even correct. Now that is casting. You cast. Okay. Now then, of course, all these numbers all taken from the accounts. The costs are all from the account. Then you must go back to the account. So that's why the first thing that we'll do as part of the standard procedure will be number 1. I must agree the carrying amount of my, let's say, PPE in the statement of financial position to the PPT notes to the financial statement that reconcile such amount. Now I use the word agree. That means is go and check whether they're the same or not. The standard law, that's my standard thing. And not only that, I have to cast the note. That means I must add up. See, mathematically the figures is correct. That's my standard procedure. Now then, the figures are all taken from the account. Agree the individual item in the note. Example like the cost of your fixed asset to your general ledger balance. So you go back to the account and see that amount is all correct. They agree. Okay. Now again, the ledger only show the balance. Like you just show me, okay, computer got 10 million. That means you got 10 million worth of computer. But in 10 million worth of computer, I believe you got few thousand unit of computer. And you can't be showing all the few thousand. Accounts don't show all these details. That detail will be maintained separately by the register. So that's why you must agree again. So that what you see in the account and what you see in the register is also the same. So you must also agree to FAR, fixed asset register. So now we have successfully compared and agreed what you see here all the way to the final. The final that we have just stopped is the FAR, the fixed asset register. Okay, so we just finished here up to the FAR. So from the FAR, you will need to do the next part of the job. So now from the FAR, we're going to do the specific test. So this specific test will be what test? Testing assertion. As test code. You must be going back to your actual asset. Okay? The whole actual thing now, to prove that there's COB. Okay? Because right now, maybe you see in the account, example that there is machine account, that the machine account, I show you that there's a balance of 5 million. And now in the fixed asset register, there's a list of 300 machines that at the end the total is 5 million. Now we just agree the two of them. Okay, we just agree on two of them. But of course, the 5 million can be still wrong. If let's say you don't have 300 machines, you only have 200 machines. The 100 machine all not there, right? So accounts is wrong. Or maybe in the 300 machine, the cost that you have capitalized is not the right amount. Maybe you pay 50,000 for the machine, but you're going to capitalize 80,000. That again, amount will be wrong with it. So there's so many things that you can make a mistake in the account that eventually this is wrong. And of course, this is wrong, this is wrong. So what we can do now to prove that what we see here is correct is we will have to prove both. That's my mission now, okay? We're going to prove both. And what's the meaning of both? This is what we did in audit evidence. So now the first thing I'm going to do, proving both. Now I will use the more logical assertion to start first, easier to understand, is to prove existence. Okay, is to prove existence. Now, in the register has a list of 300 machines. Technically, all the 300 machines must still be there. That you can see, you can touch, you can feel them. Of course, we know in audit, I can't be checking everything, right now? This is only machine only. Computer, furniture, equipment, there's so many things. If everything was I check all, then the audit cannot finish it. That's why we sample, okay, we sample. So if you're going to sample, then how do you know that the machines actually exist? Because our mindset is, of course, the client don't know which one we're going to pick. So that's why we just simply choose a few. And if the machine is there, then probability is the rest must be there. Okay? So that's the idea we do. So we just, from the fixed asset register, okay, we take the register from here, look for some of the machine that you want to see. Okay? Select some of the fixed asset and then perform a physical inspection. Confirm that they exist. Now, this is your procedure, and this is your objective. Understand? Huh? So actually, audit is like that. If you understand it, you don't learn also, you can imagine what you're going to do for the rest of the day. You just repeat only, but of course the work you do probably must modify a bit, no? Because maybe when you deal with fixed asset and you deal with cash, the technique is a bit different, but objective is the same. Now, this is what you do. Now what if you go and see an asset that you don't even know what asset is that? Because not all asset you can imagine. Maybe you're dealing with a medical company, lab. All these lists of machine, they tell you don't even know what is this. Now how do you know which is which? That's why you probably will need their help to assist you. So that's why you must see in the question tell you what kind of company. Company that is a bit technical, then you probably just gonna write down that I might need their help to show me which is the asset, so that when I go and see, I know them. Okay. Now then, number two, you must also understand there are some assets that they will not always be there. For example, you audit a company called British Airlines. They just ordered 20 new Boeing, okay, for $10 billion. That's it. I don't know how much is the value. 10 billion. Obviously, it's not small. And then you say, I want to see all your aeroplane. Now listen carefully. You tell them, I want to see all your aeroplane. So what will the guy tell you? You're crazy. All the aeroplane. That means I must get all the aeroplane to park down in the airport and wait for you to see. Then I don't do business. You see now? They say you cannot see all the aeroplane. Yeah, I show you one or two aeroplane that's still there. Okay lah. See all cannot. You want to see can? You come different day. Different day when the aeroplane touch down, you see, they go, they come, you see, you go. They take 1 month to see all the aeroplane. Now, which again doesn't make sense also. That's why you must know that this is the nature. There are some asset, fixed asset, that probably I call them, they are mobile. They move around. Okay, they move around. So maybe I tell you we have one machine to detect petroleum under the sea. That this one machine, the cost is $30 million. You want to see? Really is in the sea. You go and see. You go to the sea to see the machine. Can you see? So how to show you? It's not with me, but the machine is very expensive. You want to see. So that's the problem that we have. So it's mobile. Follow, okay? So that's why when you have this kind of thing, you must understand that you might need alternative evidence to prove that asset exists. Because as long as something is there, you will leave behind traces. Right now? For example, you go overseas and study alone. That's why you tell your mother you study alone. Okay? But there's a man staying with you for the past 3 years. So your mother come for a spot check. So you quickly ask your man to go away. And you don't even have time to clean up. You think your mother come into your house and walk around, your mother will not know that there's a man? The man never existed at that time. He didn't see the man. But your mother also can feel that the man existed, right? Look at the situation. Wow, toilet got 2 toothbrush. You don't tell me one for morning, one for night. Right? So that's why this is what we're trying to say, that you don't actually need to see also, you know that something can exist. So if you really can't see, think of that. So what would you do to prove that this thing exists? Now, for example, like you tell me the aeroplane is not there. Look for what? Look for things like maybe the sales, the passenger that you sell through the flights. All these things must have what? You know? So sales record, delivery, all these are examples of things to do with existence. Okay? Okay. Number 3. Now, existence also linked to overstatement. Would you agree? Because if you record something that it does not exist, you actually overstate the account. That's why sometimes people tell you existence test is overstatement test. Okay, so you overstate the account. Now, so if you think existence will overstate the account, now existence and overstatement will be something that come in when you're going to record a new asset. So I will link this later on when we audit addition. Okay, when we audit addition. Okay, so this is existence. And again, now put ourselves in that situation. You are now on site. Because you have just taken some of the asset detail and you go all the way to their place and do physical inspection. So you are there. And you know earlier in the fixed asset register, there are 300 machines. And you just selected some. Maybe you selected 20. There are still another 200 something machines that you didn't select. So why not at the same time, we pick some of other sample to do completeness tests. Okay, so we pick some of the other sample to do completeness tests. So how do you use that for completeness? Now, what is completeness? Completeness is if something is yours that you believe it should be in the account, it must be in the account. So if these are the machines that it belongs to you, then it must be in the account, right? So we just select another sample of your fixed asset, agree to the fixed asset register, confirm that they were recorded in the register. Now, as long as what you see is also in the register, then recorded. It's completeness. It's your objective. Now, completeness also relate to understatement. Agree? Okay, completeness also relates to understatement. So understatement is because if you have an asset but you don't record, you understate the account. So understate the account will link to, for example, you expensed off a capital expenditure to your income statement. Would that be an understatement? You buy an asset but you expensed it off to the income statement. Now, a lot of Sendirian Berhad, the Malaysian small company right now, they like to do that. Why? Because the profit will be reduced, and a lot of Sendirian Berhad bosses don't like to pay tax. So it's better for them to do that. But usually I don't know whether you come across this or not. Every time they want to expense or something, if the bill is too big, then they scared auditor will catch them. That's why they normally ask the supplier, hey boss, this bill, can you open 3 bills? Instead of 5,000, you open 1,000, 5,000, 5 and 2,000, so that you split 3 amounts, smaller amount, and you charge to account that you call as repair. Then you say this is repair, maintenance. So that probably auditor look at the amount so small, also don't bother. Then you let go, you bypass. So these things that they might do. So that's why if you want to come across detect this kind of problem, what you're normally going to do. So you must go to those accounts. Example like you say, I'll scrutinize. Scrutinize, check in detail. Fair enough. I'm going to scrutinize accounts like repair and maintenance. Okay, scrutinize, repair and maintenance. So you run through. So now again, imagine. So when you run through all these accounts, you're going to see a list of expenses you charge into the account. So let's say there's one you charge amount is 1,200. There's one you charge amount is 700. There's one amount we charge is 5,720. Well, I think immediately it attracts your attention. Wow! Of all the amount, this so big one. Now, if you see the amount is so big, then what you're going to do? You're going to verify. Is this really repair expense or is this capital expense? So how do you verify? You're going to see the document. That's where you're going to inspect maybe whatever bill or whatever invoice to confirm that expense is not capital expenditure. Not, then you know that's a mistake. Okay? That's something to do with completeness. Now, so these two things, existence and completeness, you must understand that they are always opposite one. Existence is always to look at overstatement. For example, maybe expense is revenue in nature, but you go and capitalize. But later I'll see that in addition. Okay? That's why this is for overstatement, this is for understatement. They're always opposite. But another thing you must understand that in audit, everything is risk-based. And we've been telling you that when you assess risk, you must look at risk at assertion level. So what do you mean by looking at risk at assertion level? Now, you look at these two assertions now, and you ask yourself, do you think that the risk for these two assertions will be the same? That you feel they are equally risky? That you feel that the client will be equally wanting to overstate their account as well as understate their account? But if both also equal, then there's no misstatement already. You overstate and understate the same amount, then where got misstatement? You see, now that's why you understand and think and see. Chances is it won't. Chances is either I want to overstate or I want to understate. So if you want to overstate, then existence is more risky. Now you look at, for example, a public listed company. Do you think public listed company will be more interested to show more profit or show more losses? Of course, it's more profit, right? Why must they show more profit? every quarter, if they can show better results, the share price go up, for example, and every time the share price go up, maybe they themselves will benefit from share option. So that's why they always want to make things better and better, better and better. You see, no? So that's why if they have that intention to make things better, do you think they'll be so crazy to understate their asset? No, they rather overstate than understate. So that's why if you know this is more risky than the other one, so when you plan the audit, where would your focus? Existent. Then your work will be concentrated on this assertion more than concentrate on this assertion. Because concentrate here means you're checking on wrong direction. You're checking for something that you know the problem is not there. Follow? Okay? That's about focusing on the risk at assertion level. Okay? Now, continue. Now, besides checking completeness as well as existence, then we look at ownership. So ownership is to prove what? Now, it's not called ownership, right? Okay, what's the actual name for this assertion? What do you call that? Call what? Call what? Say correctly. Free trip, Paris. Rights. Rights. Okay. And obligation. You missed one word. No Paris. Okay. So the actual name is called rights and obligation. But of course, asset is about rights. Okay. So ownership is just the word that we use in the class for easier for you to remember. Okay. It's called ownership. Now, so issue about ownership is what? That you have rights to this asset. That means the asset is yours. How do you know asset is yours? How? Ask the asset. You actually agree with me. I cannot believe it. Okay? How to ask? Go to the computer and ask. Talk to your iPad. Hey, press the iPhone Siri. Who is your owner? And then Siri will talk to you. You are my owner. Consider? Wow, very good. How do you know that asset is yours or not yours? You must? Yes, you must look at the document. There must be document that can show us. Example, if you talk about land and building, look at what? Yeah, you look at S&P. I hear some say S&P. What is S&P? Sales and purchase agreement. Okay, look for the sales and purchase agreement. What? What? What is it that you are looking for? Title. You are looking for the name, correct? So you don't just say that I'll inspect the sale and purchase agreement. Okay, you do like that is not enough. Can you see not? So what I show you? Okay, I show you sales and purchase agreement. There's so many things inside. Can you see not? The story, you know how long? Like phone book so thick. So it's like, what is it that you're looking for? You're looking for who is the buyer. Agree? That's why you must say carefully that the name must be your client. See, you're not detailed. Please be detailed to move to the extent. Okay. Now, of course, you may look at the title. Okay. Memorandum of transfer. These are examples of things that all relates to landed property. Now, if you are looking at, for example, like motor vehicles, you can look at the vehicle. Oops, I missed the word. Registration certificate. Sorry, okay. You look for the registration certificate. Again, you must be looking at the name. Okay. Now, if you list asset, you can look at leasing agreement. And not only agreement and look for the name, you must look at the nature of the lease. What kind of lease is this? Because if not finance, then you cannot capitalize also. Okay. Now, these are examples of things you see. Now, you may have other assets, like those cheaper stuff that you buy. Okay, so iPhone, iPad, you don't really go and talk to the phone. You just look at the bill. Correct? Now, they send you invoice, right? Who purchased this? So look for the invoice, for the bill, etc. And then cross-reference to the proof of payment. Who paid for it? Follow? Now, all these are examples of how you can test ownership. Now, see, we have 4 main assertions that we say earlier, and we've just killed all the 3. It's just left with one more assertion called valuation. Correct? Now, of course, valuation will have the most things over here, because at the end, the thing that we're going to check is the amount. Okay? And this amount is actually the carrying amount that you see in the statement of financial position. Now if you look at the carrying amount in statement of financial position, what will the amount made up of? Cost and the accumulated depreciation, and then you get NBV, fair enough? Now what you're going to prove is this. But there's nothing here to prove because NBV Now, so continue with valuation. Okay, guys. So opening balance, the figure come from where? Last year closing, exactly. Okay. So you know opening balance comes from last year closing. So how do you check that opening balance is right or not right? Then it depends on whether do you think the closing is right or not right. Okay, so if we put in this situation, if you just audited this year account, that means this year the closing figure has been verified by you, right? So will you suspect next year opening is wrong? No, because this year closing is audited by you. So next year opening must definitely be right, you know? So in that case, use the same idea to look at opening. Then you must ask them what happened last year. So whether last year accounts were audited, and if yes, who did the audit? Is it you or is it someone else? So all that is what we normally use to decide what to do here. So I'm not going to do this thing right now because we're going to see this separately as another chapter. So if I just make a simple assumption for the time being, so assuming if you have audited the last year financial statement, then you shouldn't feel anything strange about the figure because you have got them, okay? So you just need to make sure that they are being brought down correctly. Just make sure that figures are brought down correctly. So you can verify figures where? Where can you go and check to know your last year the last year closing balance figure is right? You verify from your last year working paper, yes, so you can just look at last year working papers. Okay, so you probably will see all the numbers there. So just make sure that everything is brought down correctly. Okay, so see, the more details one we'll see next time. Okay, alright, now we're going to see addition. Now basically addition is you buy, disposal is you sell. So to me, buy and sell is more or less the same. Okay, so one is you get, one is you dispose, one you pay, one you get money, and so on. Okay, so you're going to go through more or less the same process. Now, so what are the main things we're going to see when you buy and sell? Okay, so let's look at addition. Now usually if they acquire new asset, first thing we usually do is check whether these have been authorized. Okay, so how do you know whether the assets that they have acquired are being authorized or not? Now we can go and read the minutes of meetings. Okay, you're going to read minutes of meeting. My audit work here is incomplete or is not clear enough. Can anyone correct my point? What's wrong with what I've just written? Read minutes of meetings. Huh? Sorry? Spelling ah? Huh? Spelling? No, spelling okay. I didn't test English here, okay? So nothing wrong with spelling, no full stop, no comma, no issue like that, okay? So what's the problem? Read minutes of meetings. Huh? Sorry? It is what? Or don't just read, then you must sing. Take the minutes and sing it out loud. Can you see now? Okay, now the problem that I'm trying to test you is whose meeting that you must read the minutes. See, that's very important. Read minutes of meeting. Just when I say read minutes of meeting, in your mind, what meeting is that? What meeting? Board. Must it be board? Only board must have minutes. No, right? So end of the day, when you say look at the minutes, whether it's authorized or not, of course you must know whose meeting. Whose meeting is that? And you must also understand whose meeting that will authorize the acquisition of asset will depends on the amount involved, right? You don't tell me you go for a board minutes to look for the approval to buy 2 sets of computer that the price is only 4,000 ringgit. Will you do that? Will you ask our Najib to approve acquisition of 2 computer 4,000 ringgit for the country? No, it's too small, right? Can say that? Okay. So that's why normally you must know the amount. If amount is not big, then you go for management meeting. Okay, this management meeting. If amount is bigger, that the management has no authority to approve, then you must go for board meeting. But even if the amount is so huge that even the directors themselves got no power, then you must go for general meeting. That's why you must know what is it that you're dealing with. Can you see that? So in the exam, you must look. Maybe the question give you the amount is so obvious, it's so big that you know this is something that probably you need director. They must say it's board meeting. Or if you're not sure, then you must specify that these are all the possibility. Okay, so you can have management meeting, you have board meeting, you have general meeting. So what I want to stress is don't just say minutes of meeting. It's a very bad habit because don't know what meeting is that. Okay, so minutes of what meeting is very important. Okay, now you must look at the minutes to see whether is this acquisition authorized. Okay, if the acquisition is not authorized, then you know that there's problem already. Okay, so that's why if not, then this could be example serious weakness in control. Okay, serious weakness in control, or it could actually be, is it a fraud? Abuse in power? I think, remember, is this to do with the Lembu case that we had? Remember our Lembu case? They say that how can the director use the money to buy condo and yet no one know. Can you see? Then the non-executive director, I don't know, is it that case? I remember I read the news. Non-executive director stand up and say, we didn't know. How can you didn't know? This must be approved by the directors in the board meeting, right? So unless you tell me during the meeting you sleep, can you see that? Or you tell me that this never go through the board meeting. That means you never go through this. It's not minuted. Then there's an abuse of power. Then very clear you're wrong. Can you see that? So that's why this is why we see something is authorized or not. Okay. Now number 2. Now when you buy asset, usually there will be supporting document. Okay, there will be supporting documents. It's very important for us to inspect the supporting document. Example, like maybe you sign sale and purchase agreement. Okay. Now, so again, all these things will help us to show all the terms of purchase. Okay, show the terms of purchase. Now then from the supporting document, okay, maybe like the invoice and so on, you also can identify what is your cost. Okay, what is your cost? Now sometimes it's also important that because usually in the bill, in the invoice, they itemize the list of things that they charge. Then you must run through that whether these are capital item. Okay, maybe I bought a machine that at the same time I buy the spare part. Okay, I bought a machine, I buy the spare part. But spare part you don't call fixed asset, correct or not? So that's why you cannot capitalize the spare part. So in that case, you must split the item already. So you must run through and see whether they capitalize correctly. So from the supporting document, you must run through. Okay, so that's why very important you go through all that. Now, sometimes you buy fixed asset, especially if the value is not the cheap one. Okay, the very high expensive one. Probably they might use loan. Okay, so usually some kind of financing is involved. Example, they take loan. Okay, of course if they take loan, then you probably also need to see whether this been accounted for properly. Okay, because sometimes you need to disclose that the asset has been charged. Correct. So if this asset is charged for a loan and asset is not charged, you must disclose in the account. So you must go through all that to see that later on the disclosure section is right or not right. Okay. Now when you take loan, you gotta pay interest, and interest will link to issue called borrowing costs. So if this is a qualifying asset, you must see whether the borrowing cost must be capitalized or not, or charged to P&L. Okay, so all these are examples of things that you probably will have to consider because they are borrowing. Okay. Now then, the document will probably show amount. Okay, document will probably show amount, but amount shown on document cannot be so reliable as well, right? You look at, for example, sometimes your client, all these go and buy second-hand asset. Malaysia especially, buy second-hand, especially if they want to borrow money. Car. The car is only 50,000, but they always say that this car they sell you for 70,000. They overstate the value. Why? You can borrow more money. You know? So all these are examples of things you must see. So end of the day, you must also cross-reference with the payments made. So your bank records. Okay, so these are some of the things that you just make sure you test them. Okay, when you buy. Now similar when you sell, go through more or less the same thing. Okay. Alright, so we just look at addition and disposal. Okay, so disposal is just opposite of it. Okay, so same thing, you must have authorization. You still will have document. Okay, so you will still need to test that you received the money. So you're just going to make sure they accounted for properly. The gain or loss, all this has been dealt with. Can you see that? Okay. Now, the next issue we have here is on impairment. Now the key difference with impairment and revaluation in terms of your accounting requirement is what? Impairment is compulsory, right? Revaluation is optional, correct? So impairment is not a choice. You have an impairment, you have to recognize the loss. Now, so before you look at the issues to see, you ask yourself, okay, how can misstatement occur here? So what kind of mistake that will occur when we deal with impairment? Now, one, asset that they suffered impairment but is not being identified. Okay, so they have not identified an asset that has suffered impairment. So you don't even know that this asset has already been impaired. You don't even know. If you don't even know, will you review impairment loss? Definitely no, right? Because you only review impairment when an asset has given you the indication. So that's why if you're not even aware of it, then there wouldn't be a review. That means there will be nothing done in the account. Okay, this is one way of how misstatement can occur because there's nothing done. Okay. Now another way is this is an asset that you review its impairment. Okay, an asset that you review its impairment, but we estimated the impairment loss unreasonably. So in short, you underestimate the impairment loss. Possible? What's an impairment? Accounting wise, impairment is when what is higher than what? It's two figures you must compare. One is called carrying amount, then the recoverable amount. Okay, so you are looking at the carrying amount with the recoverable amount. Now I have an asset, the carrying amount is 1 million, and if we estimate the recoverable amount is, let's say, 0.7 million, is there an impairment? Yes, definitely. But is there a possibility that actually it's not 0.7, actually it's 0.4? Why not? Correct. Anything you can do mistake in the account. So instead of estimated them to be 0.4, if the accountant go and tell you that it's not 0.4 but it's 0.7, you're still wrong, right? The estimate is not right. What can say that it's still wrong. So that's why this is still a mistake. Okay. Now this is there are two different types of mistake. One mistake is you don't even know that there's an impairment. The other one is you know that there's an impairment, but the estimate is not right. Okay. Now, so what we can do here in terms of the audit work is, of course, number one, how can you search or you detect these kind of so-called assets that suffer impairment. Now we basically follow similar clue, okay, similar clue like what we learn in accounts. Okay, so during the audit, you just look for indication of impairment in your fixed asset. Okay, because this is exactly what the accounting standard teaches, that only when you come across indications of impairment, then you review impairment in that asset. And you probably learned that indications can come from external and internal of the business. So what are those internal? Now these are all accounts again. Okay, so it's about accounts. So all these is things that you learn from accounts. Now anyway, in my notes I have included the same point, what you learn in your accounts, in page 127. The example of indications coming from external factor, internal factor. Okay, these are examples. Okay, now maybe when I do a plant tour, I notice there's one particular machine that from the outlook is very run down, it's very old, they didn't use, they put aside. Now when I look at the machine, I can really know that this machine has not been used for so long, which may indicate to me if you don't use the asset, then this asset is practically useless to you. So is this asset impaired? No? Then you're going to ask, is this asset impaired? No? Okay. Now, so that's why if you look for an indications of impairment, and if you've come across indication, okay, yes, you come across indications. Now, then you must check, has entity review impairment for these assets? Okay, so of course from the list of impairment review, if you can see the asset that you've identified that you feel suspicious, okay, then at least they've done it. Now, but if you realize that they have not done an impairment review, then you ask them to do so, understand? Okay, so that's the first thing. Look for an indications during the audit. So if let's say answer is no, then you request them to do a review, to carry out a review. Yes. Now, after they carry out the review, then there's a review. or they have reviewed, okay, then we just need to test the reasonableness of the estimate. Okay, you're going to test reasonableness of the estimate. So have they estimated the recoverable amount reasonably? Now, the part on auditing accounting estimates will cover separately as well, okay? But you will never get a question that will go into the detailed accounting adjustment, auditing accounting adjustment by giving you a schedule, showing you how they derive the recoverable. No, you don't get this kind of question, as you know. So the question here in F8 is very straightforward, okay? So you don't have all that. So you just need to make sure that the estimate is reasonably derived. Finish. Okay? Now, so that's impairment. It's quite simple, okay? That's impairment. Now, besides impairment, now impairment is something that's compulsory. Okay? Impairment is something compulsory. Now, but revaluation is something optional. You have a choice to record asset using the cost model or revaluation model. So it's perfectly optional over here. Okay. Now, so if you have used a revaluation model, then this will be revalued by an expert. Okay. So this will be revalued by an expert, and this expert is a third party, an outsider. So now we bring in an additional issue. The issue that affects us in the audit now is we will need to consider the works of an expert. Okay, so you're actually evaluating work of another body. Okay, so you're considering work of an expert. Now, when you're evaluating work of an expert, now actually there are two parts of things that we must do here. Okay. Now, first is the expert itself. That you need to evaluate the expert. The expert. Now, only after you evaluated the expert and you're happy with him, then you must consider evaluating the work by the expert. Okay, so the expert and the work is two different things. Okay, so the expert we're evaluating, we call this as the CCO. Okay, I usually call this as the CCO. So what's CCO? CCO is the competency, capability, and objectivity. That is expert, competent, capable, objective. Okay, it's the expert, competent, capable, objective. All right, now see the CCO is okay. Then we look at the work. In this case, the work that we're saying is the revaluation. The example, like the expert revalued the land and building to 5 million. So now we are looking at the 5 million. Do you find that 5 million is a reasonable amount? So what are those things that we can do over here? Now, we should evaluate, for example, you should take the original revaluation certificate, okay, we should take a look at it. So have a site to confirm amount is indeed 5 million. So how do you derive 5 million? You must have a basis, right? You cannot just plug figure from the air. So I believe you must have a basis. So we should discuss with the expert the basis of assumptions that they have used. So if this is not the first time you revalue, because accounting standard require us to revalue regularly. So if last time they revalue once and now they revalue again, so we also look at whether you find this assumption consistent with the past, whether you find assumption used appear to you reasonable. Okay, so we look at the basis of assumption. Now usually one way for us to know whether amount is reasonable or not is to make comparison. So we can just compare, for example, with the market value of the nearby property. So per square foot, let's say they value to be $800. So you just look for the nearby property, do they fetch $800 or do they fetch much higher or much lower? Then you can use that as a basis to evaluate, is the 5 million acceptable? Okay. Now to find market value is not very difficult, right? Just look at all these advertisements, classify internet. It's a lot. It's all free, right? Can you not? Okay. Classify. Very close to the bank. The bank can even help you because bank have their own panel. They just make a phone call. Then the guy over the phone say, yeah, it's around $500 per square foot. Then they tell you the amount. Okay, right? So all these are example of things you do here when it comes to the revaluation. Okay. Now again, the accounting aspects. That once you revalue the figure, what will happen to the accounts? All that will not appear in your question. Okay. So it's only the consideration. Now this is the part to do with costs. All right. Now come to depreciation. So the audit work we need to do here when it comes to depreciation, of course, one is in terms of arithmetic. You just need to recalculate to confirm that the arithmetical accuracy is that. Okay, just calculate once more the amount that they get and the amount you get. Now the depreciation method that they have used is consistent with the method that they have used in the past, and you agree that it's appropriate. Because the depreciation rates. So we find that rates, now these accounting estimates estimating the economic useful life of your asset. So do you think that rates used are appropriate? Now what you can do is you can consider example, compare the rates with industry average. Okay, compare it with industry average. Now, if they have any asset replacement policy, that also give you leads to the depreciation rates that they're supposed to use. If let's say I have a policy that I must change every 5 years, that obviously is 20%, even though the actual useful life can be much higher, but still 20 because this is my policy. Okay, right? We can also actually compare the market value of your asset. Of course, you must use market value as in similar age, condition, second-hand asset with your net book value. So if you have depreciated your asset correctly, then we normally expect the NBV and the market value shouldn't be very far. Okay. Now you can also look at the past disposal. Because usually when you sell off the asset, now just as we say, if you have depreciated properly, then the NBV and market value should be quite close to each other. So when you sell, you shouldn't get huge gains or huge losses. But if you run through and review back all the past disposal and you notice that you see huge gains or huge losses. Now huge gain indicate you over depreciated, and huge losses you under depreciated. So if that indicate to you that you over depreciated an asset and now you're still using a similar basis, then I don't think it's right. So you will have to discuss with them about changing or reviewing again the economic useful life and change the rates. Okay. Now, so all these are things that we do for depreciation. Okay. Now, so there's only 4 assertions that we say. So confirm that assets are recorded. We've done that. Confirm that your client is owner. We've done that. Confirm that the amount is correct. We've looked at all the issue. Confirm that the assets that you've recorded, they exist, and we have done all that. Okay. So all these assertions you've proven. Now, of course, the last thing is you're going to make sure that everything is disclosed. Okay. So the disclosure is very simple. You just got to read financial statement. Okay. Just read financial statement and see whether you have adequately and appropriately disclose all details according to what the standard requires. So if yes, then fine, there's no issue. Okay. Now, so with all these things covered, then look back into what we say. Now, we've started to agree here and here to make sure that these 2 figures are the same. And then what we did is we done all the tests to make sure that these 2 is proven all the assertion. So if all assertions are there, then everything should be correct, right? But then the figure you have in the financial statement is not materially misstated. So that's the idea. Okay. So this is called substantive procedure. Okay. Now, but there's one thing that again I need to let you all know. See, a lot of times students always say that they get very confused between test of detail and substantive AB. Okay. Now, the idea is they are both about helping us to detect material misstatement. Okay. Now, in test of detail and substantive AP, now the main difference, so probably it's easier for you all to remember it this way. Now, if you are doing